What does BlackRock observe about earnings visibility that could staunch this rout?
Well, I think it's actually, what we're seeing is that it's supporting the rally. I mean, you had a blowout earnings season. And again, at the end of the day, what's going to drive earnings? It's going to be nominal GDP. We're already recovering very fast. You're going to put another, call it $1.5 trillion of stimulus in the near term. There's an infrastructure package beyond that. You're still getting the lag benefits of easy monetary policy from last year and this year. So if anything, I would say that the risk is on the right side of the distribution. In other words, if you think about what is the outlier event we could see in 2021, it's a blowout year for the economy, which should generally lead to, spectacular earnings.
Well, Russ, yesterday BlackRock put out a note where they basically said they were going underweight government debt, in particular U.S. Treasuries. And they said that certain parts of the credit market, like perhaps the higher grade stuff, not so hot, but the riskier securities, high yield, better. Equity over credit, the more risk, the better, potentially even the safer in terms of returns over the next couple of years. Can you talk about what's driving the increase in yields? Is it going to be inflation? Is it going to be growth? Or is the expectation for the Fed to just step off the pedal a little bit and for there to be a normalization?
Yeah, I mean, first of all, I'd characterize it slightly different. I don't think that the notion is the more risk, the better. I think the notion is you have a very strong economy that's likely to get stronger. Investors want to lever to that theme. They want to lever to cyclicals. At the same time, the notion of bringing down your allocation to treasuries, to the safer parts of credit, really comes down to a couple things. Parts of IG, the spreads have gotten very tight. It's not that you're at any major risk for default, but you're not really getting much in the way of a risk-adjusted return. Treasuries, you've got two problems. The first of which, even with the backup in yields, the absolute level of yields is very low. Real yields are negative. The bigger problem, treasuries are no longer acting as much of a hedge in your portfolio. What we're encouraging is to think about what parts of the market, whether it's in credit, whether it's in cyclical companies, that are going to get the largest tailwind from this improvement in the economy. And that's going to be twofold. One, better growth and probably somewhat firmer inflation, which means your nominal GDP is going to go up at a faster rate than we've seen for some time.
Russ, I'm looking at a Standard & Poor's on futures down about 2%. I mean, I understand that's a bear market. Have we forgotten what a pullback is?
Well, a little bit, yeah.
You think?
This is, we've seen this play before. The market is adjusting to the fact that yields have come up. You're also getting somewhat, well, you're not getting somewhat, you are getting a rotation. And the rotation is not that dissimilar from what happened at the end of 16, early 17. Investors that were long pure growth or long defensives are moving out of that. They're looking for more cyclical expressions. What's been crushing it? The banks. Why have the banks been crushing it? They're geared to the economy. They're a direct beneficiary from the steeper yield curve.